Welcome. My name is Eleanor Slum. I'm the program director here for our chapter of Conscious Capitalism in Connecticut. And professional members are in the room, as well as members of our Conscious Leaders Network. We have a lively student chapter. We do have members of the academic community here as well. It's wonderful to see that cross-pollination, and we have that on our panel with accounting and legal and investment perspectives on the topic of now the tax season is over and we're hearing about ESG and the need to measure and report on environmental, social, and governance goals. How do we exactly do that? So Mahfuja Malik is a member of our chapter board. She's an associate professor at Sacred Heart University with a degree in accounting from Boston University and research interests in the realm of financial accounting. Soledad Matiazzi is also on our board, co-founder and partner of Thinking Beyond Business, who took her 15 years of experience in foreign investment law and cross-border transactions and compliance over to help companies in the United States and beyond solve some of the world's biggest and largest, most pressing problems. So putting purpose right up there with profits, as we do in the conscious world. And Anna Alamani, managing partner in ESG for Pinnacle Fund Services, helping clients advance responsible investing and sustainable business practices, a member of our Conscious Leaders Network, which is CEOs and high-level vice presidents meeting over the course of a full year to delve into the exercises in the field guide to conscious capitalism and learn from each other how this stuff works on the ground. So wonderful to have you all here, and turn it over to the three of you to just start with definition of terms of ESG and how that relates to sustainability. And if you want to, ask the folks in the room with what their baseline level of familiarity is, that might be a useful place to start. Yes.
Yeah, sure. I mean, I'm sure you've seen ESG. The term has been getting a lot of good press and bad press, but maybe like just to get a sense of what do you think it is, and obviously it means different things for different organizations and different people. But if somebody wants to tell us their idea of ESG, we can start from there.
I'll jump in and throw it. My definition, personal one of sustainability, has to do with future generations of people. So that's the group that I tend to focus on is leaving the planet in better condition, leaving our social systems in better condition, and leaving our governance systems in better in as good or better condition than when we got them in our generation. So our democracy should be stronger, our planet should be in better shape, the resources should be in good shape, justice, equity, diversity, inclusion systems should be better than we got them ideally. So that's the goal. That's my idea of what ESG and sustainability is about.
Yeah, and you bring up a good point right away, meaning like when you mention long term, one of the biggest, I think, differences between what we consider sort of like typical, when you evaluate the performance of a company from a purely accounting financial perspective, it gives you a very short term view on what the company is doing, versus ESG and sustainability are trying to shift the focus more towards the long term. And sometimes, long term and short term can be, in opposition. You have some trade-offs there. So one of the purpose of ESG is also to, allow companies to be more clear and more transparent on what those trade-offs between short term and long term are. But specifically, ESG means basically when you have a company, it's a different way to evaluate your performance, but of the performance of a company. So it includes factors that have to do more with the environmental impact of the company, the social impact of the company, meaning the impact on the workers and the community the organization operates in, and also governance. So what are the principles and what are the processes and the policies that govern the company? In investing, which is my point of view, when we talk about ESG and sustainable investing, so we need to differentiate. Sustainable investing it's a very broad term, but basically it means investing with a goal of achieving some goals that they're not purely financial. So it's not just your return, but it has a goal of financial positive returns and positive impact. So when we refer to ESG in investing, we are referring to how do we measure an investment and how do we assess, an investment, and how we make investment decision based on the impact and not just the financial return. This has been a trend, a strong trend in the capital markets. Capital is shifting towards investments that are able to give this impact to investors to achieve this goal. Although it's still very, very, it's still a very new field. And so what we mean technically when we talk about ESG investment product, we mean a lot of different things, and we can go into the details, but just wanted to give you an overview of what it means, just in general, ESG and sustainability in the investing side.
I think I know what Gavin mentioned. I think it's kind of the definition of, sustainability or conscious organizations, or how business should look like with these new externalities that we're living in. ESG for me in particular is kind of the language that the financial world is using to measure the risks and measure opportunities related to sustainability, related to all these issues that Gavin mentioned. So it's a framework, it's a risk assessment framework that is used by investors, by the financial community, to measure and track and report on all of these issues that more and more businesses are dependent on. And that is how it connects with sustainability.
That's a great point. What Gavin started, in general, the term sustainability means to leave the earth in a better condition for the future generation. Now, if we link it to business point of view, for every business, the main objective is to generate profit. That means economic benefits. That's a primary objective, and we cannot deny that. But now here, if we bring the concept of sustainability, it means that doing the business in such a way that companies will meet their economic profit without compromising these three major areas, which are environmental, social, and governance. So to me, sustainability is the way or practice of business to maintain a desired level of these all three areas. And what Saad mentioned, and of course, Anna also give you some idea from capital market perspective, when we need to do this type of business practice, we need to think about measuring those terms, because those are very broad and complex areas, all three areas, environment, social, governance. So how we can measure those and how we can say, well, this business is making profit without compromising these areas. And here comes the concept when we link it to business perspective.
Yeah, and I just want to make a point, sort of taking a step back. I think it's important to understand that some of the push towards sustainability in investing is coming from retail investors. I would say, institutional investors, so pension funds and large institutional investors are pushing this, but they're pushing it on behalf of their investors, so their own retail investors. And the reason is that, of course, younger generation are more in tune, more interested in these aspects, in solving global issues like climate change or inequality. Of course, this is more, and younger generation, remember, are inheriting money, from their parents. So slowly they are making this decision that according to what their values are. So, but it's also, so on one side is the demand pushing this change, But on the other side, I wanted to sort of remind people that this is also a change that is driven by technology. The fact that all of a sudden, in the capital markets, it used to be, that investment decisions were made based on data and information that it would get, processed by very few sources, right? Trusted sources, the analysts at the investment banks, the equity analysts, very few sources, or the company itself through their, financial statement and public public information, investors meeting and so on. But it was very controlled. Now, all of a sudden with technology, all of a sudden there is access to a tremendous amount of data, alternative data from alternative data sources. And there are actually scrutinizing companies for areas of operation that were not scrutinized before. So, any employee of a company can go online and say something about, the culture of the company. Any customers and consumer can say something about the product. And all this data is there. And this younger generation of investors are relying on these sort of data to make investment decisions. So it is a push that is driven by values and then demand from investors, but it's also a push that is driven by, more generally, systemic change in the way investment decisions are made, in particular, the rise of alternative data. So when you have all of a sudden these alternative areas of operation being scrutinized, you realize this is the need of investors. On the other side, GAAP accounting has been created 30 years ago where these data were not available. So GAAP accounting is still looking at, for example, of these, a good example I always make is intangible assets. If you look at what traditional GAAP financial accounting tells you about intangible assets, it still reflects, which is not very much, it still reflects a reality where intangible assets were 10% of the value of a company, because it tends to be, because the value of a company was driven by fixed asset, the machinery, the facility, the real estate. Now the value of the most valuable, the biggest companies, based on values, are basically all intangible assets. So it's 90% is driven by intangible asset. If you think about any tech companies, it's the brand, it's the intellectual property. As you can see, there is a traditional accounting that is still not evolving. And so this is a demand from investors to ask for more information that they need to use to make investment decision. And so eventually, the hope is that our traditional accounting will move towards including this disclosure as the norm. SEC has been doing a bit of work on that, with the proposed rule. And I don't know, Soledad, if you want to speak to the SEC rule that is.
Yes, that's a great. It's true what Anna just mentioned. You have all this data, all this informations. Investors need to make informed decisions whether to invest in your company. What is the value, how resilient, long-term, as Anna mentioned, is this company. And you have all these disclosures that have been done voluntarily in the US because it's not regulated yet. But I was reading an article the other day that 96% of the S&P 500 index companies are already reporting climate-related change, sustainability issues in one way or another. The problem is that this is very fragmented. Everybody's reporting according to different frameworks, and there's a lack of clarity, comparability on the information. And that is why was one of the consequences that the Securities and Exchange Commission within the US started working on rules, a proposed rule that Anna mentioned, to standardize this reporting, specifically with climate change. That is an issue that is increasingly concerned globally, and regulatory bodies around the world are catching up. Europe is much ahead. Many other countries in Asia and Japan and UK already have regulations for public companies to report on these issues, and the US is catching up. And the Securities and Exchange Commission, specifically in March 2022, proposed rules to disclose, requiring public companies to disclose on climate-related issues. This framework that they're using, I divided very briefly because it's a complex legislation, is formalizing what already is happening voluntarily in the market. And it has kind of three buckets, the regulation. So one of the buckets is that public companies, registered companies, should identify and assess and disclose climate-related risks that are related to their operations, their unique operations. So they need to identify if there's any risk out there, physical risk, like could be climate, or transitional risk, that could be consumer behavior, new regulations globally, that could affect your company financially. And you need to report not only this is identified within your company, but also you need to report how you're measuring this, how you're tracking this, who is oversighting this within your governance, and what are KPIs you're using. And if you're mitigating this, if you have plans to mitigate this, and what are your plans in the short, in the medium, and the long term with regards to climate-related risk. So this is one bucket. Another bucket is asking companies, public companies, to disclose their greenhouse gas emissions. So companies will be required to disclose the scope 1 emissions, that is all the emissions that are related to resources that you control or that you own, like your building or a car, transportation. Then you also will need to disclose your scope 2 emissions, that is those that are indirect emissions that are related to the purchase of electricity, that is for your heating, for your cooling within your business. And for certain companies, when it's material, you need to disclose your scope 3 emissions, that is your indirect emissions that are related to your operations, the products that you buy, the services that you buy, all your value chain. So you need to be able to disclose what are your carbon emissions with regards to that. For scope 3, it's required only for companies that are already set a target and they're already voluntarily reporting on this, then they will be required to do this. For companies that are specific industries like fossil fuels and automobile industries, they will need to disclose it. And there's a lot of discussion of which companies should disclose this or not, because it's a big task, right? To go through all your value chain to disclose it, and what is going to be the scope to do that. And a third bucket that is related to what we're discussing today is that you will need to, within your financial report, you need to include a footnote on how this relates to your financial metrics. What resources of your company are you using with regards to measuring your carbon emissions and with regards to your climate risk mitigation and assessment, and how the carbon emission measurement and reduction is affecting the bottom line. So it seems to be a lot what companies are required to do. This applies to public companies that are registered before the SEC. But the reality is that companies are already providing some way or another this information, and this comes as a way to standardize and provide a framework that everybody can use so that investors can make more informed decisions. It has been an issue of debate, and now it's under commentary and feedback process. It has been for a while, and they expect that the regulation will be effective by the end of the year. They are waiting. There's been back and forth on comments, and I think it's been because they want the regulation to sustain litigation. They want to be a strong a regulation that can take into consideration the different views from different investors. and it will be part of the annual reports. And one of the things that we were discussing with Anna and Mahfuja is that even though it's related to public companies, it does not only affect public companies, but it has a strong repercussion to middle market private companies as well. Why? Because those companies that do business with public companies will be required, are part of their value chain, and will be required also to start thinking about this and start measuring this. Within the line of work that I do, I see this more and more often. Small companies, manufacturers here in Connecticut, that are receiving these assessments from their clients, that are big public companies or global companies, and asking them, what are you doing in terms of this? Can you show me some progress in 1 year or 2 years? It's important for you to start measuring this. If you don't do that, then you will not be within our list of preferred suppliers. So it's something that is becoming more and more relevant for these private companies. And also, if you're raising funds or you want to exit and sell your business, investors are looking into this data as well. If you're thinking of doing an IPO, you're a private equity, you're a private company and you're thinking to do an IPO in the near future, this will be required for you for doing the IPO. So it's also strongly related to private companies as well. And the trick and the challenge is how to measure it, how to incorporate it. And I think, Mahfuja, you could give us some light on how companies could do this within the frameworks that already have in place.
Sure, thank you very much, and great questions in the chat box. First of all, yes, the question came from Ali, and you already answered that. When SEC makes any rules, it's mostly for the publicly listed companies. But when you have business interactions, private companies, small, mid-sized firms, in your business connections or supply chain, whatever the regulations you are following, that would impact to other businesses. And also another question, I think Paul made this about the cost. Yes, here is one issue whether one size will fit all, because reporting, measuring all this ESG, that would be really costly. So how it will be appropriate for mid-size or small size farms? So that's one question. And Soledad was mentioning about the EU progress and what SEC is doing, and what Anna mentioned. I'll start from that point. So now think of financial reporting. What do we do here in the USA? For financial reporting, we follow the US GAAP. And most of the other countries, especially EU countries and rest of the world, they follow IFRS or international standards. Now, the European countries are IFRS or IASB, they are way ahead. They are making it mandatory for the EU firm to report your CSR numbers. They already developed the CSR directive. SEC is still working on that. So if we now think about the challenges for these ESG reporting and measuring, I would not say there is a lack of framework. There are several frameworks that are evolving, especially the GRI, Global Reporting Initiatives, or the EU taxonomy, or the SASB framework. But the problem is there are multiple frameworks and there is a lack of coherence and consistency. And since there is a lack of regulations, so it's making the firms confusing which framework to follow. So if SEC makes it mandatory, we have to follow the SASB framework, or kind of harmonizing all the frameworks. It may remove the problem in some ways, but again, the quantification of the data is also important. What Anna mentioned earlier, if you look at a traditional balance sheet, what do? We see mostly all physical, tangible assets. There might be some intangibles such as trademark or patent, but our traditional accounting cannot measure intangible assets, cannot capture non-financial information. So when we think about ESG reporting, the question comes how we will quantify it, or even if we need to put a footnote in your annual report or present some qualitative data, all companies need to follow the consistent framework Otherwise, it will be difficult for investors or people like us to compare company versus company. Now, how we will measure it? Maybe for some environmental issues, it's easy to measure scope 1 or scope 2 carbon emission amount, or in terms of dollar value, maybe carbon tax or climate change risk liabilities. But if you think about the social and governance part, how are we going to measure it? Should we rely on quantitative measure, convert it into dollar cents? Our title of today's discussion, should we rely on qualitative? But what would be the qualitative standardized way? So here we all are kind of struggling. Another thing, even if we come up with some standard frameworks, SEC made it mandatory, all public firms follow that structured work. Another question is the assurance of the numbers or qualitative data. So who will assure or who will audit that, okay, these numbers are reliable, the way they measure and the way they report, those are reliable. Well, big four firms are training their auditors how to audit those numbers, ESG numbers. So it's not only about training the auditors, we also need to educate the investors. Firms also need to set up their KPI, own KPI numbers, targets, and it's all about harmonization. So I'd say in that point, it's the major challenge is not a lack of standard, but the major challenge is harmonize and standardize the standards. And definitely we need legal implications. If SEC would not make it mandatory, no firm will not feel like forced. No firm will feel from their moral perspective, we need to report that number, but we need legal compliance and regulatory standards too.
And to be fair, Mahfuja, I think this has been a process on the work. Organizations around the world globally are trying to work, as you mentioned, towards this harmonization. And I see the light at the end of the tunnel because this year, G20, G7, countries around the world, non-governmental entities, big companies around the world got together with the different frameworks. And there is one non-for-profit organization that kind of put everything together. That is the International Sustainability Standard Board, I think it's named. But they are putting together, they approved a harmonized framework to report globally on issues regarding sustainability, not only climate-related risk, but as you mentioned, on the social aspects. And it's in the process of getting the final veto. This was in February. And if you think about regulatory bodies globally, you have this organization, you have the European Community, and then you have the Securities and Exchange Commission within the US. And I think the three of them agree that the framework in general terms of the Task Force for Climate Financial Disclosure and the framework of the greenhouse gas emissions framework are the ones that should be the base for any framework globally. So that's a big advancement in terms of the long journey that took for all the different parties globally to agree on one particular framework. But to the regulation, to how to apply it, how to learn and get educated on the best way to integrate this, it's going to take some time. But as Anna mentioned, we have to think about not only on a short-term basis, but we have to think that our businesses have these dependencies, that we need to incorporate it in our business models, and we have to think long-term in terms of resilience of our organizations with regards to each one of these issues.
I just wanted to go back for a second to Paul's question, because I think I hear this a lot, like, how do I do this practically? This is not feasible for me. I have a small team. I don't have the resources. I would say, one good way to think about this is also start where you are, meaning there might be things that you are not really aware of or that qualify as ESG, you are already doing. I would say also, like, in terms of like what kind of process to start, is just start with a statement of what ESG is. That's why policies, policies, people don't like policies, but it is a good starting point, meaning it gets you to think about what is your purpose, talking about conscious capitalism beyond, the financial, making money. What is your purpose? It gets you to think about what are your core values and what are the principles that you operate with. So it has a little bit of also has to do with your company's culture. Once you have identified a purpose, values, and principles, you can think about what are the issues that are material in my, in my industry. And I just want to give you an example, because I just worked with a client, which was a private equity fund, very far from, anything sustainability related from a cultural perspective. But, they mostly invest in companies in industrial services. So these are companies that do airports, they build airports, they do construction work, roads, and these kind of things. And so we reflected on what are the issues that are material to them. So what are the issues that, besides being important in terms of value, I've also have a financial impact potentially on their performance, financial performance, on the bottom line. And one of the things that we found out is that obviously in these kind of, in industrial services, your workers and your employees are, it's your biggest assets, basically. And when looking into the issues that are important, we started to think about workforce health and safety, right? And employee engagement and these kind of things. And then we find out that actually within this area, there were already regulations in various jurisdictions that they're active, but their portfolio companies were already asked by the law to report, for example, on employee accidents, right? So we started to develop metrics like, the total incident rate, the frequency of this incident, the total sort of like money that they spend in potential fines for that. And so we started developing metrics that were kind of already something kind of low-hanging fruit for them, because they were already reporting on these. And then we started to think about employee engagement and employee, so were they measuring that, and how to do that in a better way. So the point that I'm trying to make is that don't think about these as, I'm going to have to measure everything, and how is it? It's very difficult. Start where you are. What's important to you? What are you already doing? And you might do better, more consistently, more systematically. And start from there. And chances are, I'll tell you that some of the things that we're talking about, you are already doing. You're just you're not just doing it in a way that is structured and formalized.
And that's a great point, Anna. We're working with a client that received an assessment from a public company. It's one of the largest clients. And when doing this assessment, we realized there's so many amazing things they're doing that they're not necessarily thought that it would be between the E or between the S. But the problem was, and what the regulators are expecting and what clients are expecting is, okay, these are done in a very silo and fragmented way and not strategically. We want to see consolidation. So we want to see where this fits within your strategy and how are you measuring progress. And the expectation is not to as Anna mentioned, is to do what is material to you, what is important to your stakeholders, what can bring value to your company, and focus on that. But on that, set the targets. Who in the company is going to monitor this? What is the progress? And be audit ready. You made a statement that you're a company that is is focused on diversity and inclusion. Do you have the metrics to prove this? So, how was last year? What is the goal that you set up? How you are progressing at the end of the year? And what are the results? And communicate this in a very transparent way. And I think this is what is being asked to provide. And what Anna mentioned, it's use the systems that you already have. Maybe you have a risk management system in place or a operational system in place. Can you add these KPIs within the system that you already have in place as well. And one thing that is important as well, that we're working with one client in particular, is look at the statements that you are already making in your website, in your reports, in your marketing materials, and see if there's any inconsistency, if there's any gaps, and make sure to fix that moving forward, because that's a big risk as well.
The other thing that I would add here is also like for aspects that are like more technical, like, you know, emissions, for example. I know there are a lot of platforms out there that would help you with that. Platforms that actually have also access to data, like from utilities. So they would take, you know, for example, your utility bill, and they will help you to assess sort of, you know, your consumption. How does your consumption compare to your, you know, sort of region, and how could you do better? You know, you could hire also like this type of like energy consultant. They go through a whole analysis of what your current consumption is and how to, you know, you could make it better, or you could make it more efficient. And so those are starting points. So there are out there, you know, vendors that you can use. I understand that some of these companies, you know, might not have the budget, but again, if you take it as a, you know, as a phased step-by-step process, you can get, you know, you'll get there.
And start with governance.
Yeah.
I feel
Right,
like
exactly.
who
That's
in
a
the
good
company is
point.
gonna do this? Because that's the thing. It's like, who's gonna champion this? You need one person, or I don't know, it could be a team for different parts of the department. If you're a small company, are you a CEO? Who's gonna take some time to look at these issues? I think that would be kind of the starting point, and then the materiality assessment internally, externally. Use what you have, be very practical, focus on what is important, and progress, not perfection. You don't need to do everything. You need to show, the expectation is to show progress. It's not to have everything figured out right now. It's to start thinking about this and understanding how it's affecting your business, because maybe you have business opportunities that you didn't think of. With one particular client there, they started selling the waste, and that became a revenue for the company that was not there before. That is within the E of ESG, right? And another client, we developed an employee handbook. There was engagement tools that were applied, and that also had a positive repercussion in talent retention for the company as well. You can see it from different points of view, but the most important thing is practical, I think, and very transparent about what you're disclosing. Very careful about what you're disclosing to make sure it's consistent and it's backed up the same way that you will back up financial information, I think.
Thinking about it, I'm thinking about, you know, the burden and the work to do and all that kind of thing. And then I'm also thinking, you know, could you also, you know, not in a really tiny company maybe, but in a medium-ish size company, could you actually just invite teams of people, just ask, you know, who in the company would be interested in working on justice, diversity, equity, inclusion things, or who in the company would be interested in tracking our greenhouse gases or whatever, and form a, you know, let a group, because there are bound to be people who are interested in those things, and let them sort of emerge, form a little group, figure out how they're going to tackle it. And, you know, maybe you have an outside expert come in and give them, you know, a hand initially get started or something, but then you've got, you know, now it's not relying on one person, but it's a team of people who are passionate about that thing. And that would, you know, overall just increase, you know, engagement within the group, because they, you know, those people would be like, yeah, we're making progress, or we're not, or whatever. They'd be more likely to get things done.
Yeah, I think that's actually a very important point, because sometimes you don't want to have this policy being pushed by just one side of the organization. You want buy-in and consensus from the other side, from everyone. So usually, like, I've seen companies created like a sort of cross-functional committee that includes parts of different functions, so that everybody is kind of aware, and it helps with the implementation of just one policy. So they try to build consensus, but also that it's almost like, you might train them and then they train other people in their departments on how to deal with this situation where they're a bit ambiguous or they're not quite sure. So you kind of you can train them as a way to train, the whole organization. And then another thing that I've seen that, obviously it's also important that at the board level, there is some kind of oversight of the policy implementation. So if you can, just include senior members of the senior management or actually the board, and this should become kind of part of the routine, because I've seen this. If the discussion starts being done at board level, it becomes more of a strategy of the organization and not just like a reaction to.
I was thinking and as you were saying that too, I was thinking like the OSHA, companies are manufacturing companies anyway are required to have an OSHA safety committee, and the committee is, I think, supposed to be less than 50% management on the committee. And that way you get, the idea, OSHA's goal is to make it real. So if you just have a bunch of management people saying, oh yeah, we're awesome, and rubber stamping things, it's not getting you very far. But if you have actual people who are, involved in the daily work and they get a say on the safety things, that obviously is much more important. And same sort of thing if you get, so you want the people who are passionate about safety on your safety committee, and you want the, I would think ideally people who are passionate about the environment on your environmental committee, or your, different group on your governance committee and that kind of thing. But that way you're getting those people who are actually really excited about that stuff, and they'll just tend to drive it forward on their own. Then you're just giving them, in permission and creating the path for them and letting them go.
And understanding what it means, right? What it means to apply this, because sometimes you have this sustainability policy or the ESG policy, and then each one of the, different departments is, okay, how am I supposed to apply this to my operations? But if the people are involved cross-sector, there's a clearer understanding of how do they apply this to their day-to-day operations.
I'm wondering how the integrated reporting piece fits in, Mahfuja. Is this it relates to what we're talking about now, right?
Right. So the reporting annual reports, or SEC's reporting requirements, are mostly for public firms, but small firms, mid-sized firms, private, even partnership, they also prepare their own reports. So when we think about SEC's regulations and reporting requirements, disclosures, it mostly will be in effect for public firms. Now, for private partnership, those firms, it's up to them whether they will report and to what extent they will report. It depends on who are their stakeholders, partners, or other businesses they are dealing with. For example, if Paul is doing a small business and Paul has suppliers, customers, or any other type of community engagement, and they demand the data, definitely it's good for information dissemination perspective to include all those information. But as a small private firms, there will be no legal liabilities, not for fulfilling those obligations. Because if you want to be listed, you need to follow the SEC regulations if you are listed as a public company. Or a small firm, private firm, if they want to go for IPO, I remember some of you mentioned, then this will be part of your requirement. And you just cannot do it once you will be listed. You need for IPO, and to be listed, you need to start the journey a few years ahead of time. So when firms grow, they want to be public, you will have more disclosure and reporting burdens will be on you.
Yes, I part of this co-working space in Marianne, and they have kind of a Shark Tank initiative where companies there come to pitch for funding, and these are all young generation of leaders from different industries, and all of them, for me, when I go to these events, I see that all of them include information about this. So the new generation, the new businesses are already considering these issues as part of their business strategy. That's what I've seen. So this is evolving towards that direction, I believe.
I think that in general, what integrated reporting also, it's interesting because it does take some of these, we were talking about this intangible asset like human capital, right? Or intellectual capital. And it tries to, so let's say, for example, human capital, how do you go from, reporting your costs, your salaries, benefit as a cost, from to reporting as an asset, and that, and how you can do that. And when you do that, as a lot of decisions will follow that will be different. I'll give you an example, which I think it's an example that we can all relate to if we have a small business and big business. Healthcare costs, for example, huge. It's a huge sort of issue in America, and it's been a problem for small businesses because healthcare costs keep going up, and you have so when you start reporting, you're reporting your healthcare costs as a cost. You are making all sorts of decisions based on the fact that if I have to increase the bottom line, I have to, lower my healthcare costs, and that oftentimes is, actually could translate into excluding some parts of the populations that have the need of the healthcare because it's more expensive, right? So you go from these to consider your healthcare expense and benefits as a value that you're generating. So when you're reporting in your annual report, you show how much of how much you spend in benefits, how much you spend in training and skills development, and what kind of other services you give to, benefits you give to your employees. So you're starting all of a sudden to consider the cost as something that actually is sort of an asset and creates value. And if you get into a regular communication with your investor, for example, or with your stakeholders, changing this, perspective, it does change some of the decisions that are done, right? That have a financial. So I guess that's kind of what I think ultimately the purpose of integrated reporting is about, to shift some of these, to shift a bit the approach and the logic. And I just want to say a point about European Union, because I think it's super interesting to see what's happening in European Union on this topic. Because, as you know, Europe, the European Union is one of the governments that has been trying to actively really support the transition to more of a sustainable economy through regulation, real regulation. And one of the regulation is the European taxonomy. It's just a classification of sort of all businesses and economic activities based on the level of sustainable environmental sustainability. For now, it's just related to environmental sustainability. Thinking also about the social aspect, but what it shows, it classifies companies based on sort of a sustainability status. And a lot of people might think, oh, what is the purpose of that? But if you think about it, let's go back to the example of the healthcare benefits, for example. If the government at some point, as has always done, uses tax incentives to incentivize and reward positive or negative corporate behavior, right? So if European Union is looking at this taxonomy and classification as a way to then sort of incentivize from a tax perspective some companies to provide, for example, better healthcare benefit, right? That's a huge potential, because it is something, if I'm a company, I spend more in healthcare benefit, my employees are healthier, they're also going to rely less on public programs, public health programs that are very expensive to the government. So it somehow actually translates into a benefit also for the government, which is incentivized to give this tax, benefit as a result. So you start to see a model where the business is not just, the business is more actively participating and involved in giving these essential services that usually were public goods or just reserved to the government, right? So I think that's a super interesting evolution that this could take, where there is more of a partnership between the government and the private sectors in dealing with some of these public, goods, essential, goods and services. Yeah.
Thank you, Anna. And yes, it's with regards to this carbon price, specifically with no, I think jurisdictions around the world, I think we have around 40 countries that have some kind of policy or system to consider this, and the US is one of the ones that is behind. So hopefully this evolution will also come here, which is complex. We have different states with different interests, and but hopefully this will be something that will follow the global trend as well.
Since the European Union is now way ahead of us, and I talked about the EU taxonomy, and the EU Parliament and the Council has made it mandatory or adopted the CSR, Corporate Social Responsibility Directive, and they made a plan in 2024 and 25 in 2 phases. All large companies will adopt it, and then in 26, small, mid-sized firms will adopt it. And in the long run, they also timelined it by 2028. Any non-EU parent company also need to follow that directive. And they guess that about 50,000 companies will be under this directive. Now you think of it, the European Union companies are following this directive. Now how it would impact on the US firms? So there are 2 ways we can think of it. First of all, cross-border listing. So we have many US companies. They can be listed in European stock exchanges to raise funds. If they need to go to that capital market, they need to follow those directives, those rules. But now, if they are not used to report all these CSR and ESG information, it would be difficult for the US firms when they want to be listed, they want to get access to the European capital market. Another thing is that we have many conglomerate multinational US parent company who have subsidiaries in European Union and all over the world. So now the EU is also making it non-EU parent companies mandatory to adopt those directives, to follow those taxonomy. And in that way, it will also be difficult for the US parents to do business or to make this compliance mandatory and follow for the subsidiary companies. So this is one way that think of it, the challenges that the US companies will be facing unless there will be no like compliance and regulations from the SEC here in the USA. So this is really important, and we need to think all about it, and also how it will impact overall the capital market and different stakeholders, because we are not doing businesses in silos, right? We have multinational companies doing businesses all over the world. So that's one important point. I just want to share how the US taxonomy would impact on the the European taxonomy would impact on the US companies.
Talking about what Glenn mentioned, the interconnectedness of stakeholders and this principle that we follow at Conscious Capitalism, and the importance of this, understanding what are our stakeholder needs today, what are they value most, and value could be financial value and other value as well, and how we are in tune with those needs to make sure that our business is resilient in the long term.
Thank you. Wonderful conversation, and I realize that this may be an ongoing series because there is so much to be said and yet to be explored that's really important for the way the businesses operate. And thanks, Paul, for being the voice of a small business and the struggles that we all face in executing these important ideas, and really value Anna and Mahfuja and Soledad's sort of international perspective here, because as we all said in our different ways, the US is still catching up. So pleased to be a part of this conversation. Wonderful as always. I've learned so much in the last hour and very grateful for your combined contributions. Thank you so much.